happy to see so many friends here today, and I have promised to Sandra and to the DBBC team that I'm going to entertain you. And I'm super happy to have a fantastic group of people here. I would like to start from the gentleman from the other side to introduce himself, and we come to my side.
Very good. Thank you very much. Thank you for having me. My name is Ousmène Mandeng. I'm a senior advisor to Accenture's global digital money and digital asset practice. I have been doing this for the last 6 years, accompanying and supporting many of the leading CBDC projects around the world. I worked previously at the IMF and in finance for 20 years. I'm delighted to be here, looking forward to the discussion. Thank you.
Fantastic. Paul.
I'm Paul Brody. I'm the Global Blockchain Leader at EY, and I'm also the Chairman of the Enterprise Ethereum Alliance. And a few of you might have managed to grab a copy of my book, which is Ethereum for Business, which was back there earlier.
Alisa?
Hey guys, Alisa DiCaprio. I'm Head of Industry Engagement at Swift. Before I took this role, I was Chief Economist at R3, which is a blockchain company. It was a very exciting time. We did a lot of CBDCs, particularly in the Middle East. And looking forward to this panel.
Fantastic. I'm Dimitrios. I'm Senior Fellow at Wharton Business School. Before that, I was Regulator in the European Parliament, and I was co-drafting the stablecoins part of MiCA and the DLT pilot regime, which is about tokenization of financial instruments. And I would like to kickstart this conversation talking about the future of money, sharing a story with you that 6 years later I can actually share. When the Libra team came to Brussels to present the idea of the project, they stepped in our offices and they said, you know, you have a monetary union already for 10 years, but you have a very fragmented payment system, so we are here to disrupt you. We are the future of money. And the EU officials made 1-2 steps back and they say, wait, guys. First of all, you are not the future of money. Second, you are not going to define what is the future of money. And if we can imagine what the future of money should look like, maybe it's some combination of artificial intelligence, tokenization, and disposable identities. So I would like to ask each one of you to close your eyes and tell me how money evolves at the stage we are right now, and how you imagine the future of money 20 years from now, starting from you, Alisa.
Excellent. So we're starting with the easy question. Cool. I think, you know, with the future of money, I'm going to go in a different direction than I think a lot of maybe we're thinking about. Is in the future of money, we're still going to have cash. In 20 years, we're still using cash, right? If you look at what Sweden did, right? They tried to go cashless. It didn't quite work. There were a lot of problems, right? So you have people that need to use cash, the elderly, children, immigrants. So I think cash is going to stick around as much as we don't like it and keep trying to get rid of it. But I think on the other side, where we're talking about digital money, there's going to be a proliferation and a great variety of types of money. But within 20 years, there will be a more harmonized regime for it, and it'll be more transferable. Right now, you can have a CBDC, it works only in your country. You can have a stablecoin, you can transfer that across borders, but it's not particularly transferable in a lot of regulated institutions. So I think that's really where these things are going to go.
Okay, bold.
So, and I'll go in a slightly different direction. I mean, certainly tokenization is the future of money, but what I've been thinking a lot lately is the idea of streaming. We today kind of think of money as discrete chunks. We move money around in discrete chunks. Companies keep large pools of capital. There's trillions of dollars of working capital out there. But what's happening right now is that the cost, stablecoins and blockchain rails and programmability are basically taking the cost and the time required to move money down to zero, right? You can move money anywhere, you can set it up programmatically, and it's almost free. And it's useful to think about this idea of what if you could move money for free at any time, in any way, and it was instantaneous. The answer is you wouldn't keep big piles of cash in different places, you would stream it. You would bill your customers daily, your customers would pay you daily, you would pay employees daily, you might even pay people per hour. The rate at which kind of we process transactions and manage our process is going to speed up enormously. And so I think the future of money is streaming. Basically vast continuous quantities and flows happening automatically based on what we do.
Okay. So for me, money has different dimensions. Money is mostly about who's the issuer of money. And typically money, what we call money, is a liability of our financial system. The innovation, I think, to some extent has been the advent of external monies. So monies not from our financial system, like Bitcoin, for example. Bitcoin is much more akin to gold. It's not a liability of anyone. And when you hold it, it's not a claim against someone. And that, I think, to some extent, is an innovation. I think we have seen, and we are seeing with tokenization, a new format of money, but then it in itself is not particularly exciting. For me, it's mostly about, and I know that we talk about it a little bit later, but it's a lot about the underlying infrastructure that is processing money. So I think we have so far not seen that much innovation. Stablecoins are often being mentioned, but the instrument itself is extremely conventional. It's simply a commitment to convert at par a given amount of money that is economically similar to a bank deposit or a money market fund share. So the innovation isn't there. And I think what we need to explore much more is really the delta. Where is the innovation, and where can money really make a difference compared to how we use money today?
Thank you for saying that. A few weeks ago, I was in an economist conference. I had 2,000 treasurers and bankers in front of me, people who actually move payments cross-border in very difficult places, and they sometimes find it very, very difficult to transfer money from their place to an emerging economy. They have 6 different banks sometimes, different layers of know your customer, and a lot of friction, a lot of opacity, and this generates fees. This is the one dimension. The second dimension is that we have a gap between the messaging of the payment and the actual transfer of payment. And the third is the gap between the settlement and the finality of payment. And this makes me think that it's not just about the medium of exchange, it's an infrastructural concept that we need to improve to streamline the operations. And I would like to start with you. What kind of different infrastructures we need in order to have better payments? And do your clients see that the development of a stablecoin maybe or a CBDC is not just a medium of exchange, it's a different mentality of infrastructure?
So I think the problem you mentioned, and this is indeed the key problem, is intermediation. Money movements are highly intermediated, and that means there are a lot of frictions. Now, this is typically the case, however, only in cross-border payments. In domestic payments, we, I think, have eliminated, at least in the advanced economies, eliminated most of these frictions. So moving money quickly back and forth is not an innovation that we can do. Where stablecoins come in and where indeed they may offer something new is they are being treated as a bearer instrument. So while money typically can be transferred only by novation, meaning a claim on my bank becomes a claim on your bank, with stablecoins this is different. But it's an extraordinary regulatory exemption that gives stablecoins an enormous advantage. I'm not quite clear why this advantage is being given to stablecoins. I think it should be, if so, made available universally. But by that we can solve for the access problem and allowing more direct monetary relationships to emerge, reduce intermediation, and thereby reduce frictions and allow money to move more smoothly. Yeah.
Paul?
So there is, so first of all, I think your point about like the bearer asset is spot on. Like that is a big departure from what we've had in the recent past. And it is a big regulatory advantage, and it's one that's now going to be conferred upon everybody who wants to deploy a stable coin. But there's a couple of other things that are going on from an infrastructure perspective that are worth watching. The first is this entirely new infrastructure that's being built to facilitate a really rapid integration of stable coins. We've seen the announcement today, Shopify is integrating USDC. Stripe is buying Privy, they bought Bridge, right? What's happening is the entire global commercial infrastructure is building a new payments infrastructure. The first new payments infrastructure, probably since the credit card industry, is being built on top of the existing crypto rails. So new infrastructure, and there are a ton of companies that are building up all these little niche solutions, like I have 20 different versions of a US dollar token, how do I make them all interoperable instantaneously, right? Stuff like that is happening. Second thing that's happening is integration. So you're gonna see, we're quickly getting to the point, we're not quite there yet, but we're very close to the point where it's gonna be really hard to tell the difference as a user between an on-chain application and an actual FDIC insured or nationally or regionally regulated bank. These things are all gonna kind of look the same and they're gonna function the same. Back in, I think, February, it took me about 10 minutes to set up a MetaMask MasterCard in my Apple Pay directly linked to my MetaMask wallet, right? And then immediately go out and buy a burrito with it in fiat currency, right? That level of integration is going to be universal, it's going to be widely accessible, and so you're going to have these new rails and they're going to be integrated to the old rails, and we're going to very quickly get, both in the B2C and the B2B space, to this point where people are going to choose the most efficient routing for their transaction, and it's going to become automatic.
Alice?
I think that only holds if you're talking about a national infrastructure. If you're talking about cross-border infrastructure, we're not there yet. I think we do have new rails coming out in individual jurisdictions, but when you start to try to transfer money, CBDCs, stablecoins, whatever, across countries, there's different regulations, there's different infrastructures, and they don't match. So I know as Swift, our vision is that you can transact any asset on our infrastructure. We're not there yet, but we're working on it. And so I think that's an important part, which both of the previous panelists have brought up, is you really need to have this link between legacy infrastructure, which is used now, and the new infrastructure and the new types of instruments. Because the way that they're going to scale is if you can use it on the legacy infrastructure.
So that both is and is not true, and I'll be a little bit provocative and disagreeable, if I might. So it is true if you're a large enterprise. So one of the interesting things that we see at EY, because we're one of these traditional law-abiding companies, is that we get clients all the time who are like, hey, can you help us, connect country A to country B at a much lower price? And the answer we often have to say is no, because stablecoins may be legal in country A, but they're not legal or regulated in country B. So that's true in the business sector, but it's actually not true for individuals and consumers. Not because it's not legal, but simply because most governments do not have the resources or the will to go after millions of street vendors and individuals. And so what we're seeing is rapid creeping adoption of dollarization, stablecoins, and new crypto rails from the bottom up, regardless of what the regulatory infrastructure says. And it's fascinating to watch this process happen, because we can tell our corporate clients, this is happening. We can see the data right underneath your nose. The sand is shifting. You just can't access this yet.
Right. So the difference is retail versus wholesale.
Right.
Completely agree. Yeah.
But I think it's also important to point out it's not a technical problem. Right? Moving money around is not a technical problem. If we all share the same network, irrespective of where we are spatially, we can move money extremely quickly. The main problem is regulation, right? And I think we cannot, with new tech, solve for regulation. So we need to do both. We need to rethink regulation, and it's a lot about acceptance. How do we regulate acceptance of a medium that may be foreign to the country where it's being used? And I think this is where we really need to make progress. Yeah.
And I think that's mostly true, but I will say that there are still huge technical gaps in how a lot of this stuff operates. It's not quite there yet. So we have the big picture stuff, I can send you USDC anywhere, but it's not so easy to send you USDC and have it automatically translated into sort of some British sterling pound equivalent. We don't have quite all the pieces, all the on-ramps and off-ramps don't work entirely smoothly. And then interestingly, in the B2B space, it's actually still quite difficult. Last year, EY became the first firm to receive a fully automated B2B payment through SAP's Digital Currency Hub, right? And that's basically a system integration that didn't exist until very recently. But now, if you have SAP's Digital Currency Hub and you plug that in and you configure it, you can automatically set up things like stablecoin payments. But there are a even if the big picture stuff is done, there are a million small points of integration that are not ready yet. And still there's a ton of tech work to be done.
Staying on this topic of regulation, do you feel in your communication with regulators across the world that they all understand the need for stablecoin regulation or digital payments in the same way, or their views are sharply different and this may be excuse the differences we have in the speed of adoption? And to which extent do you think that the existence of regulation actually accelerates adoption? Because I have a statistic from the European Union. We delisted Tether, and Circle never recovered the demand for Tether, and despite the fact that we have a regulation, the demand for stable coins is actually reduced, and we have the regulation in place. So what is your feeling? What the regulators understand, what they don't understand, where are they going to speed up the process, where they are going to delay things? Alisa.
I think the one thing I would start with is it's not necessarily about regulation, it's about merchant adoption. I mean, this is what we've seen in a lot of countries.
See in Europe now.
Yeah, exactly, right? I mean, you can have regulation that allows this, that makes it legal, that everybody's happy with, but if merchants don't take your stablecoin or they don't take your CBDC, what's happening? So I think that's really a big issue. And to your original question, do regulators kind of understand? I think absolutely. I mean, everybody's looking at this. You are very skeptical, and I know you've worked with the regulator.
I saw their eyes.
I don't think I think there are many regulators that do not understand, and in particular, there's still a lot of denialism around whether or not we really need to have like stablecoin regulation. There are still people who think that somehow a central bank digital currency will be a substitute. CBDCs don't work. They have largely flopped. They've mainly flopped because central banks don't want to deploy them on public blockchains. They don't want to allow them to be programmable. And so what you end up with is just a slightly fancier version of a real-time gross settlement system. And most countries already have that. So I think there's still some level of denial about the fact that stable coins are really the future. And the value proposition, what people fundamentally want is this open accessibility and programmability, and they wanted to do it on a computing platform like Ethereum, not on a government-run closed system.
I think there are different things here we're talking about. On regulation, I don't think we need new regulation for stablecoins. You could argue if you want to issue money, you become a bank, and then it's very clear what your obligations are and how you're going to be dealt with. Economically, stablecoins and deposits are similar. I don't think there is a need for another category of money. On stablecoin versus CBDC, these are completely different things. One is central bank money, and the other is private money. Central bank money is the preferred medium for large value payments. I don't think that stablecoins will be able to substitute central bank money, and I don't think that's the idea at all. So I don't think, and I think it's a mistake, to think that because we have stablecoins, we don't need central bank money anymore.
I'm not saying that. I'm just saying that CBDCs in particular represent a very small value proposition improvement over RTGS. The juice, as they say, is not worth the squeeze.
I don't think so at all. I think the backbone of our payment system is central bank money. And this is where we need innovation and we need to do new things, in particular in cross-border. We can, in theory, connect our large value payment systems, but we don't. So we are exploring new architectures. For example, I've been working on Project mBridge for quite some time, which offers a completely new architecture how to settle foreign exchange transactions using central bank money for the first time in cross-border payments. And I think this is where the innovation is, and this is also where the need is to strengthen our backbone. I think conducting payments at the retail level, at least in many countries, not in all use cases, we have mostly solved.
Well, if I may share some of the experience from the European Union in this kind of discussions, we had a lot of misunderstanding of the actual consequences of having privately issued stablecoins in the European Union. We had, on the one hand, the people from the central bank saying this is going to create problems in the transmission mechanism. We lose the control of our transmission mechanism. We lose the control of our monetary sovereignty, and this actually actually is an argument that flies a lot in a geopolitically intense environment, despite the fact that the foreign exchange is run in dollars and this didn't cause dollarization of the European economy. All the commodities are traded in dollars and this didn't cause dollarization of the European economy. But these kind of arguments work very, very good if somebody wants to kill an alternative on that. And well, I really don't know to which extent we can have this symbiosis between CBDCs and stablecoins. I remember central bankers, Bundesbank people said, we don't want to settle a financial transaction with something that we don't issue and we don't control. So this is a cultural element here that we need to fight for. But is it a battle that it makes sense to fight, or we just give some space to stable coins or alternative ways of transferring value and let the central bankers do their stuff? What do you think, Alisa?
I mean, we already see them moving at different speeds in different countries, right? So in some countries, you see stablecoins kind of the main part of digital money. In some countries, it's CBDCs. It used to be that China, if you remember, did not allow stablecoins, so you only had CBDC in theory. So I think there's that. So I think there's no reason that they can't coexist. But I think the problem that this presents for central banks, which was kind of brought up a little bit earlier, is that you can't control your money supply anymore. Every country now becomes a multi-currency economy because you have the ability to kind of transact these different digital currencies that aren't necessarily part of your sort of formal financial system.
Well, can I interject here, because I think this is not correct. The concern when it comes to money supply is a stablecoin is simply a substitution of monetary assets. Right? It doesn't create money, okay, unless it comes from outside, from abroad. But a stablecoin is simply a substitute for another form of
I was talking about
asset.
cryptocurrency. So yeah.
Cryptocurrencies, which indeed can, increase the money supply, but only, it would have to be substantial really to make a dent, I think. Right? The concern about monetary sovereignty, I think, is a completely different thing. The concern should not be whether people are using a given monetary instrument, but in what unit of account is that instrument being issued? That should be the concern. And if indeed, we are now starting to use, say, stablecoins denominated in foreign currency, and we have dollarization, yes, in theory it could be a problem, but dollarization has been a problem for decades. And in Latin America, most economies are highly, highly dollarized. And so this is not something new. See. So I think we also need to sort of, at times, take a step back and not exaggerate a problem which, to be quite honest, I think it is an exaggeration if suddenly these stablecoins, lead to those monetary instability.
Oh yeah, no, I don't think stablecoins will do that.
What I think, you bring up a really interesting point. So early on, sort of Bitcoin maximalists were like, listen, Bitcoin will provide this kind of floor on the behavior of central banks. It will prevent them from debasing the currency and mismanaging it. Actually, that's what stablecoins are doing. Stablecoins are basically saying that the minimum standard is you need to have a reasonably independent central bank with a relatively low inflation rate and a stable currency. And it's very interesting. Stablecoins are only really worrying to countries that don't have that thing, that don't have independent central banks and don't have stable currencies. If you look at places that do, European Union is a really good example. Nobody goes around trying to pay for stuff in dollars, right? People are keeping their savings in euros. They're quite confident in the value proposition. And of course, every stable coin is just a dollar or a euro or a yen in a bank account somewhere. So I think the fear of loss of monetary control is substantially overstated. And I actually do think a big success of MiCA is bringing more entities in-house. I think the difference, you said there's less demand for stablecoin. I think that might be a trick of the statistics in the sense that people were marking their stablecoins as in
Euro-denominated stablecoin.
Pardon?
Euro-denominated stablecoin.
Yeah, well, I think we will gradually, over time, we did a forecast last year, and we sort of expect ultimately, not immediately, ultimately, stablecoin transactions will look something similar to kind of global monetary positions and cross-border trade, because at the end of the day, if you're an enterprise and you want to manage your risk,
it's not about having dollars or yen or euros, it's about having your revenue and your costs in the same currency and not being a business that is also like a financial service that is speculating in currency.
Thank you for saying that, because I have a recent statistic in my mind. The dollar, the US dollar is the 58 point something dominant currency in the world. Second is euro with 22 point something. What we see in the stable coins is a completely different picture. It's a 99.7% in dollars, it's 0.4% in euros, and then everybody else. So is the stable coins, especially the ones that are more successful and denominated in dollar, a potential accelerator of dollarization of the global economy? Does make this dollar stronger in the coming 20 years, or this is something that you expect to be balanced over time? Alisa.
Well, I think, you know, the conversation about de-dollarization is very prominent right now. And certainly you see with a lot of the regulatory changes, less faith in the US dollar and more efforts to potentially explore other currencies. So I think that's that's absolutely true. But the dollar is also pretty well established as a reserve currency. So it's going to, I'm not sure this is going to happen in 5 years, right? I mean, it's going to be a slow change. So I think we're moving in that direction, and they're opening the door. So for example, China has a new balance of payments facility in ASEAN +3, fully funded in renminbi. The door is open. And so I think that's a potential challenge, but I think it's not happening today. I mean, not tomorrow.
So the 99%, you know, dollarization in stablecoins, I think, is a reflection of people satisfying a tremendous pent-up demand in emerging markets for U.S. dollars. But that's not the. You know, my expectation is when we see substantial onboarding from B2B and B2C in Europe and other places, our forecast is that the dollar dominance drops to about 70% over the next 10 years, and then falls a little bit, you know, gradually falls towards kind of the mean. It has to do with where adoption is. We're in a really strange environment right now where 90% of all the money in crypto and blockchain is technically offshore. It's in sort of outside of the US and Europe and other sort of heavily regulated jurisdictions, even though 99% of the world assets are onshore in these regulated jurisdictions. We think this business is big, but we've actually just barely scraped the tiniest surface of what the long-term potential in this space is. And it would be misleading to think that the data we've seen so far is how the market's going to shape out as a whole.
Mm-hmm. And I think not lose the perspective. I mean, yes, stable coins have increased, you know, the transaction volume, but at 700 billion transactions per month, it's nothing compared to the transactions we have in the rest of our payment system. In FedWire alone, we have 91,000 billion transactions per month. So stablecoins have been increasing, but you know they are still very, very small. On the dollarization, I think there is a fundamental concern, is that if you look at the real economy, emerging markets represent about half of the real economy, and yet their currencies play no role in international transactions. And that is a fundamental problem and a tension for decades. Clearly this will have to change. And so we will need to see an orderly integration, in particular of emerging market currencies, into the world economy. You could call it de-dollarization, I would call it a path towards greater currency diversification, and I think it's very desirable. The economics are very strong. It will lead, I believe, to more stability than the huge dependence that the international economy currently has on a single currency, which is the currency of the US, which is managed to satisfy monetary conditions in the US and not in the rest of the world, and that is a fundamental problem. Mm-hmm.
So I would like to close this panel by very briefly asking you how you would advise people to choose their means of payment in the coming periods that promise a lot of innovation. What are the criteria they need to have established when they choose a means of payment? Who wants to start?
Stablecoins on Ethereum.
Okay, this is odd. It's not. Please elaborate.
Simple, programmable, widely accepted,
that's what we're going for, right? It's the utility value.
Okay, sir.
We haven't spoken about the blockchain, which for me is really the innovation. You know, the fact that we are using an external financial market infrastructure to issue money, that is really where the innovation is. And I would hope that blockchain will play an increasingly important role. It's a publicly available infrastructure. It has all the functionalities that you would normally need. And what I will hope is that different mediums, it doesn't really matter who, including central banks, should be considering deploying on blockchain, and I think that could be a huge contribution to making payments more efficient.
Alisa, the last words of wisdom?
I mean, I would say if you're going to choose which currency to use, you're going to choose which one is most stable. And I think that can be almost anything, but that's the most important part of this. This is why, you know, dollar-backed stablecoins have kind of moved ahead of algorithmic stablecoins.
I agree with you. The informational sensitivity of the asset determines the adoption and what we use and what we don't. Thank you very much for this fantastically and vibrant, conversation. I hope you enjoyed it as much as I did. Let's move. Thank you.